Today, I will start with the traditional theory of the portfolio management. In the portfolio management, there are two theories connected to portfolio management. One is traditional theory, the old method, and the modern theory. Over a period of time, the portfolio management has changed. It has taken a different shape. So the old one is called as traditional theory, maybe 60, 70 years before. And the modern theory has evolved over a period of time. So let us try to know first the traditional theory of portfolio management. Then we'll move on to the modern theory of portfolio management. The traditional portfolio theory deals with the evaluation of return and risk conditions of each security. So it reveals the subjective nature, the value of a particular security or scrip or a share depends upon the quantum of the amount of dividends that the company declares. And not only that, the PE ratio of the share, the EPS, earning per share of the company share, the holding period of the particular share, etc. So it recognizes specific type of risk and non-risk factors. It was based on the risk itself. As you all know, the risk can be measured for each individual security by calculating standard deviation. From the standard deviation, we can know the risk involved in each security, that the lower standard deviation will be chosen usually because the risk is less. The highest value of SD tells about the high risk involved in each of the share or a security. Traditional portfolio selection has been reviewed earlier as an art form. Perhaps even a craft. So how it is called as an art? The selection of security must be preceded by the attention to the financial planning. The financial planning requires a careful consideration about the needs and provisions of individual investor. The investor should, before entering into the market, have to look into various basic living expenses for his and family, then his savings, the insurance required to cover all the risk, and the shelter. That is, every human being requires a shelter. So for that, shelter cost, like a rent, lease, own house means the expenses to maintain the own house, like that. Then the investment in securities may be proved as a purposeful activity. Financial discipline is the most important element to an investor who wants to be successful in the stock market. So without the financial discipline, the person cannot be successful. So the traditional approach recognizes several basic tenets. The basic tenets means basic principles for building a best portfolio. For building a best portfolio. First, the investor prefers large to small returns. That is, usually the The investor wants to have more returns, don't want small returns from the securities. Secondly, the way to achieve this goal is to make more risk or take more risk. So to achieve more profits, more return, they have to take more risk. The third one is the ability to achieve the higher return depends upon the investor's judgment of risk and the ability of his to assume what kind of a risk the person can take. So there are different type of risk the person can take. So the traditional theory also takes into consideration the various factors like what we have discussed earlier: interest rate risk, purchasing power risk, financial risk, the taxation in the country, the marketability, so etc. Generally, the investors are interested for higher rate of return from the securities in which they invest. Therefore, they will have to be facing high risk also. The investor ability to achieve high returns will depend on many factors. Not easy to get more returns. The many factors which they have to depend upon, or the factors they have to consider upon, will be the quantum of risk level to be faced at an is an important one. What is the risk level they can take it up? Portfolios are presumably constructed by employing securities associated with varying degree of risk and also non-risk elements. Always risk is not the only one. The convenience, availability, etc. that also to be considered. That is only called as a non-risk factors. Spreading money among the various securities will always reduce the risk for an investor. There are some assumptions connected to traditional theory that should be known to the student. I have given some points here. The first one, it assumes that the market is inefficient. To what extent market is inefficient, we cannot say. It has a lot of volatility. Maybe because of that, people call it as inefficient. It also thinks the fundamentalists can take advantage of market inefficiency situation. That is, who looks into the fundamental analysis before investing. So even though market is inefficient, they can take an advantage and make profit out of any market if they depend upon fundamental factors, fundamental analysis. Then the fundamentalists can earn quick profits. To what extent it is true, I don't know. People make more money even through non-fundamental analysis also nowadays. So how far it is true has left to the people. The next one is it considers that the fundamentalists will accept the potential growth of a particular company for predicting the future trend of the share prices. So the fundamentalists will go through or have an eye on how the share price of a company is moving around, and they take a good company, they use that company share prices to predict the future trend of the share prices of that company. But prediction is not so easy all the time. Prediction is done through statistical tools like trend values, correlation, etc., etc. The traditional theory also suggests the following: an investor should make sufficient provision of money after all adjustments of his family expenses. As the fundamental theory says that the money which is required for their day-to-day living, that should not be used for investment at any point of time because it is always risky. So the investor should take out the money from the savings, then only he has to invest in the various investments. Otherwise, the family will be in trouble. Their day-to-day expenses cannot be met. Then the investor must strictly stick to the financial discipline. That is, not haphazardly invest the money. Systematically, they have to go for investment, and that amount also should be taken care, how much risk involved in it. So not borrowing heavily, not depending on outsiders' money. So etc. is the financial discipline is all about. Next one is the investor should take greater protection from inflation. This comes under inflation risk. Future is uncertain. The rates of various products and services usually keep increasing. So our investment should cover the inflation rate. Earlier also we have discussed the inflation in the country is 7%. Your investment should give more than 7% return for an investor. Then only it is a protection against inflation. Next, the success of the investment game will depend upon the investor's psychology rather than stock market gimmicks. So there are different of investors we have discussed, bulls, bears, etc. The psychology of the investor that makes the person success or failure in the stock market game. The gimmicks are always therein. The drama will be going on in stock market. So who takes the market towards which direction is unpredictable, not so easy. So the traditional theories are basically the old one, and modern theories have come after 1950s. So we call it as MPT, modern portfolio theory. So this is a bit different from the older one, the traditional one. The modern portfolio theory indicates the maximization of return through a combination of different securities. So these MTP do not consider investment in a single investment is good. They always think the investment in multiple securities or different securities is good. Not only that, it should be a diversified one. I'll explain further. So this theory tells that the risk can be reduced by combining low risk securities with high risk securities. So there should be a combination all the time. That is the best way to overcome the risk. So some should be lower risk securities and some should be high risk securities. So that will balance the returns for the investor. So this theory depends upon the concept of diversification. So it believes the risk can be reduced only by diversification. Without diversification, the risk cannot be reduced. That is the underlying point under modern portfolio theory. Modern portfolio theory was based on the research work of Harry Markowitz and William Shaw. So Harry Markowitz theory in his paper publication called Portfolio Selection, which was published in the Journal of Finance in 1952. He was later awarded a Nobel Prize for his work on modern portfolio theory. So that is the first one, modern portfolio theory. So it is based on some of the assumptions again. The first one is there is a free and perfect flow of information. So earlier years, the perfect flow of information and free information was not there. Maybe it is suitable for this situation in the modern world where the information about the company, about the market is available. easily, but I cannot I cannot tell it as freely available. So for that, we need to spend time and money and energy to get the information about the market, about the security. Next, it believes that markets are perfect and absorbs all information quickly. So perfect market you may not find anywhere usually, but there are some situations we call it as perfect market wherein the demand and supply will have an impact. So all information connected to any market or any organization, company is perfectly syncs therein, faster therein. The next one is the riskiness of the financial asset in the portfolio is to be seen in the context of market related risk or portfolio risk, but not in isolation. That means any financial asset has to be compared with the portfolio risk or the market risk connected to that. So individually, we cannot look into what is the risk connected to a particular financial asset. If there is no comparison, then the risk involved in that particular investment cannot be known. So always comparing will give an idea about how risky the particular the financial asset is all about. So everywhere comparison is required. Otherwise, we will not know the superiority and inferiority or number one, number two, we cannot be knowing therein. So it is very much important. So this theory also indicates that the returns are the same whenever the investor enters into the market. To what extent it is correct, I don't know. The returns sometimes, as all of us know, will keep changing, depends on the market uh, and the various effects on the market, various factors that affects the market. So may not be the same for every time the investor enter into the market. So other one is this theory is based on the use of beta. Beta is a measurement of risk. So it measures the risk connected to the market. So beta is a measurement, is measuring the market risk for a particular situation, particular day, particular period. The modern portfolio theory depends upon the following factors also. The three factors are there. The first one is diversification. Second one is concept of dominance. The third one is the role of beta. The role of beta. So first one, let us take, as I told, modern portfolio theory completely depends upon the diversification. So without diversification, there is no modern portfolio theory. So that has to be known very clearly by the students. So diversification is basically mean investment of funds in more than one risky asset. Investment, nothing but investment, more than one investment. Every investment, every asset is risky only. And the basic objective of this is to reduce the risk. The question comes, why there should be a diversification? So as we have discussed now, low risk investment, high risk investment. So like that, different investments will be there to reduce the risk. We cannot avoid the risk, we can only reduce the risk. So to reduce the risk, it is very important that the diversification has to be done. The investment has to be done in more than one asset. So any investor who can make good returns on investment by making use of the technique of diversification. So without diversification, very, very rare an investor will get good returns. The modern portfolio theory generally assumes three forms of diversification. So diversification is not one type, there are three types. Simple diversification is the first one. Over diversification is the second one. Efficient diversification is the third one. So what is the meaning of the simple diversification. First, let us try to understand. It involves a random selection of portfolio construction. A common man or a common investor could make a better returns by making random diversification of investment. Random means without thinking which one, anyone can pick it up randomly. It is the process of altering the mix ratio of different components of a portfolio. That means the change in ratio 20%, 30%, 50%, the ratios in the investment can be changed. The simple diversification can also reduce the unsystematic risk, which we have discussed earlier, unsystematic risk. The research studies on portfolio found that 10 to 15 securities in a portfolio will bring sufficient amount of returns. So it is not that investment in 1, 2, 3, 4, 5. So various research studies done by experts, they say there should be a minimum 10 to 15 different type of investments or securities or the shares that only will bring sufficient amount of return. So this concept reveals that the prediction should be based on scientific method, not just random as such. The predictions has to be on the statistical or scientific methods. Next one is over diversification. So investor have the freedom to choose many investment alternatives to achieve the desired profit on his portfolio. So earlier we have discussed various types of investment alternatives available for an investor. So however, investor shall have a great knowledge regarding large number of financial assets spreading over different sectors, industries, and different companies. So usually the knowledge will be there for the investor, but the investor should also take more care about the liquidity of each investment, the return on each investment, the tax liability of each investment, and more than that, the performance of each investment. That is very, very important to be taken care by the investor. Without performance of a company, all these factors will not be holding good. The investor will find problems usually to handle the large number of investments. It is not so easy to handle large number of investments. So it involves more transaction cost and more money will be spent on managing over diversification. Simple diversification is quite easy to manage. Over diversification is not so easy to manage. The cost will be more of maintaining it. If an investor involves in over diversification, there may be a chance either to get higher return or exposure to more risk. So all the problems involved in this process may also result in inadequate return on the portfolio. So because of that reason, the return also may come down sometimes. So because of the various type of risk connected to it. The third one is efficient diversification. It means a combination of low risk involved securities and high risk instruments. So this is the best way always. So efficient way of diversifying is having both low risk and high risk instruments or securities. The combination will only be finalized after considering the expected return from an individual security and its interrelationship with the other components in the portfolio. The securities shall have to be evaluated and thus diversification to be restricted to some extent. Efficient diversification assures the better return to an expected level of risk. So risk also will be there, return also will be there. So particular level of risk, if you are able to take that combination of or that composition, when you taken care of, the relatively good returns will be there for the investor. The modern portfolio theory indicates that always the risk can be reduced by a balanced diversification. But diversification is not so easy. It requires a lot of talent, knowledge of industry, knowledge about companies, knowledge about various products of the company, product lines of the company, business environment, and not only that, in-depth analysis about the market share of every company, the growth areas, potential profit of the company, and so on and so on. There are so many things connected to that. Then only it is easy for a person to reduce the risk. Therefore, the modern portfolio theory hopes in diversification to achieve always the desired goal or the better goal. The next one is the concept of dominance. The return of portfolio depends upon the accepted level of risk. So as the risk increases, usually we say return also increases. So therefore, if an investor wants to increase the return, he has to bear, or he is supposed to accept the higher level of risk also. He wants more return, but less risk, usually not possible. The portfolio managers have more freedom, usually in building up a better portfolio, because they will have more information about industry and company and the various securities, and they can build a better portfolio. So they have an opportunity to add risk-free financial assets in the portfolio compared to more risk financial assets. Remember, risk-free means doesn't mean that there is no risk at all. Always risk is there, but we say risk-free financial asset means usually less risk. That's it. So not completely free from risk, like government bonds, treasury bills, bank deposits. So they're all low risk financial securities or assets. That's why they're called risk-free financial assets. That's it. So if he incorporates such less risk financial assets, then the risk can be reduced in the portfolio. And not only that, when such bank deposits or government bonds are included in the portfolio, the risk reduces. Along with that, the return also reduces, because the return will be less because the risk is less. As you know, bank deposit interest rate or bonds are all 4%, 5%, 6% like that, not more. So the concept of dominance shows that equities can be combined with bonds and other less risk financial assets to enhance the return and minimize the risk. So dominance is nothing but include the less risk financial assets in the portfolio. That itself is called concept of dominance. Next, the role of beta, that has to be understood very well. The beta is the measure of volatility faced by an asset or a portfolio. So it measures only the systematic risk, not the unsystematic risk. Another name for beta is called the market risk. So the systematic risk can be reduced by beta. It measures sensitivity of the return of one asset to the market return. So any financial asset will have a total return consisting of two elements, risk-free return and risk premium. So already I have told about risk-free return. That is the return which faces little risk of liquidity for a period of investment, not completely risk-free, little risk, little loss possible. So that is going to be called as the risk-free return. So risk premium is a return for risk taking, and it varies from asset to asset. So risk premium is also to be considered. So modern portfolio theory explains that diversification reduces the total risk subject to companies' unsystematic risk. The beta's importance lies for managing non-diversifiable part of risk. In the capital market, different financial assets are available, as you all know, maybe equity share, debentures, bonds from government or the public sector or the companies. So among these instruments, equity shares are most risky, followed by debentures, which are less risky, and then the public sector bonds and government securities are the least risky. So different financial assets will have different risk characteristics. Money market instruments also like treasury bills, commercial bills are also very less risky because they give less return also. So the risk characteristics of various financial assets are different. That has to be understood by the investor. So generally, the major asset classes are used for portfolio building by mutual funds and professional fund managers. So they will consider different types of goals therein, maybe current income, then capital appreciation, preservation of capital. So no investor wants to lose money, but everyone wants to get more return from market through efficient portfolio. So there will be a search for capital gains always, which involves the loss of capital, high income, frequently associated with high risk. So modern portfolio depends upon factors like investment strategy, risk management strategy, duration of portfolio, target returns, etc. So these are the various factors connected to this. So in the next, this one, I will take up the different types of different important modern portfolio theories in the next class.